Good morning, everybody. Welcome back into Mining Stock Daily in this week's long-form episode. As promised, we have our returning guest, Mr. Paulo Macro, back in studio for a long conversation, talking all things precious metals, but we also dive into the critical minerals aspect of the markets, the U.S. government taking more equity positions, and some interesting news earlier this week, and then also the very tight supply ongoing with the Grasberg incident that happened, Freeport McMoran. We also dive into that, and really it's just exemplary of how tight the copper market is. So a lot of in-depth conversation with Paulo. I highly encourage you to listen to it in its entirety. Big thank you to Vizsla Silver, Integra Resources, Equinox Gold, and Revival Gold for the continued support of Mining Stock Daily. We put out a lot of updates this past week. If you missed any of them, please go see them over at miningstockdaily.com or parent company clearcommodity.net. All right, everybody. One and only Paulo Macro back in studio. Let's dive in. Paulo Macro, my friend, it's been too long. Good to connect with you once again.
This is great. Thanks so much, man, for having me back on. It's nice to catch up. We've got there's nothing going on in the world of mining and resources, you know?
No,
What's there to
the
talk
world
about?
the world is quiet, peace amongst everyone. Nobody's bickering or at each other's throats anymore. I mean, it's just, what are we kidding, man? Like last time I saw you was back in February, and you came on the podcast with our good friend the Koala, post a retreat down to Argentina to see his site visit. But this is we haven't chatted really on the channel since then. So there is a number of topics you and I need to really hammer down here. Love to pick your brain and how you're seeing markets and all that, but I don't. It's just, it seems like every day there's something new that you have to kind of put in the back of your mind and watch things play out. The chessboard is constantly in motion, and economies and markets and politics is just insane. It's almost each day I kind of wake up and it's like, oh my God, what am I going to see today? You know, that's
We're
kind of
making macro great again, man.
is that what we're doing? Okay.
Yeah,
Well, let's dive in. Let's dive into the macro, and I want to pick your brain. And we should start out with the obvious. I got to talk to you about gold. This has been an amazing run, just a crazy outperformance of almost anything else since the beginning of the year. The gold miners are starting to pick up. Even today, as we're recording Thursday morning, the gold miners are outperforming the yellow metals, so that's nice to see if you're dabbling in this space. But I really want to pick your brain real in here. This move in gold as we kind of reflect and look back in the majority of the year. What is gold? What is this narrative that the gold trade has been telling you, been telling markets, been telling investors? What is that underlying narrative?
sure. Um, so nothing groundbreaking from my end in terms of what's driving the gold price. In a word, it's debasement, right? It's the financial, monetary, fiscal backstop that's forcing big money that's wildly overallocated to financial assets to seek out real stores of value. And if you're my buddies Vinny Daniels and Porter Collins over at Seawolf, the ex Front Point guys from The Big Short, they like to say, we're really bearish on deficits, so we're really bullish gold. And it's pretty much as simple as that. I will say, from a current right here right now perspective, there are a lot of vocal bulls out there, and for good reason. The trend is your friend until it ends. I think there is a bit of froth in the gold price, but I also know that the bid from foreign central banks is never ending, particularly out of Asia. But I do get a little nervous right here, right now, that we're approaching another juncture in macroeconomic conditions that kind of ties everything together, from the dollar to the long end of the U.S. yield curve to U.S. equities and Mag 7 and the concentration issues that everyone is well aware of there, to the AI bubble. I used to say froth, but yeah, it's what's happening here is totally bubble. We're well into what can we lend against this stuff to keep the plate spinning. So we're piling leverage on what was purely an equity story. And there's always the risk that as correlations come together and we go risk off, that gold and the white metals, which I've been a big fan of over the last few months, get caught in the crossfire. My One of my first early mentors in the business over 20 years ago used to tell me, he was an Australian from Melbourne. He used to say, "Mate, even pretty girls get hurt in the bus crash," and you know, gold is possibly no exception. So I'm always interested in watching how an asset will perform in that kind of environment, because if gold can hold its own, kind of flush out some of the retail money that's now in the trade, and maintain kind of an orderly correction or chopping of wood like we saw after the April high, where it sort of went nowhere for a little while. That's a very telling sign that the debasement narrative and the allocation or reallocation of massive flow, once it returns, will give you kind of the kindling for the next move higher. And it's a big market, but in the context of where, of other market sizes like U.S. equities and global debt, it's elephants through a keyhole. So that's kind of the
Mhm.
higher order thinking there. I do have some concerns and reservations in the very near term, and would love to see. I'm not calling for 3,000 before 4,000. It's not that kind of asymmetric downside to me, and I don't tend to trade against the primary trend. It's kind of a rule. More often than not, when I break it, I lose money. So I wouldn't be shorting or even buying puts here. I'm happy with the gold I own, and I kind of leave it there.
It's with that summer consolidation, the April, it was about a four from April and then 4 months on there. You had a really nice consolidation. Gold, we thought might bust out or might break down. Just hung out in price there before it finally moved back up, and here we are again. $3,700, give or take, tagged 3,800 on the front month contract earlier this week, and I think that was a pretty good telling sign that things are getting a little overdone. I mean, so that's the narrative. I mean, that's the fundamental narrative. But let's talk about a little bit of the philosophical narrative behind everything going on, and that would be, the headlines of the autonomy of the Federal Reserve, having executive administration people being placed into that board seat. Stephen Mirren, allocating for a 50-point cut instead of the 25, which was delivered last week. But we can see these things kind of playing out, and as many of our friends have written, what President Trump wants, he's going to do everything in his power to to get what he wants, right? And so as people are kind of expecting this, let's talk about kind of the way the system has been built, and maybe we're starting to see fragility in these systems. How much of that is playing a part in kind of a move towards gold and non-risk assets like that?
Oh, 100%, huge part of the equation here. For me, I know that people wax philosophical. Gold is a store of value. No, it's money. No, it's a unit of account. What have you. At the end of the day, for me, I keep things philosophically pretty simple, and um, capital and where it kind of goes to or from, because the entire world is a giant flow chart of capital. And if you can figure out where the arrows are pointing, um, and sort of get there first and drink upstream from the herd, you're going to be okay. For me, gold is not so much kind of, hovering and hanging out on base like cash, but more a sign of confidence, in public assets in particular. And I mean public in the kind of government sense. And, you know, it's interesting that people are sort of rediscovering it, as sort of an opt out to what the government can touch. And there's kind of a merger there with the philosophy around Bitcoin as well, as kind of an opt out, from the system that starts with the monetary base of the Fed and leverages up through the collateral of the Treasury, and extrapolating that to countries around the world. Um, to me, it comes back to confidence, and I think to your point about what we're seeing in terms of rolling institutional crises of confidence, whether it's Fed independence or the U.S. government balance sheet and the not only the deficits right here and now, but the contingent liabilities that are still on the docket for the next 2 decades to come, reminds me a lot of the and stop me if you've already heard this. I feel like I may have mentioned this in a prior podcast, but I'm a big fan of Herbert Hoover's memoirs from the Great Depression. They're freely available online. If you just Google Herbert Hoover, hither and yon, we'll find the right page on that book. He likes to say that during this new stage of the Depression, the refugee gold and the foreign government reserve deposits were constantly driven by fear hither and yon over the world. We were to see currencies demoralized and governments embarrassed as fear drove the gold from one country to another. In fact, there was a mass of gold and short-term credit which behaved like a loose cannon on the deck of the world in a tempest-tossed era. And I think that describes perfectly the uncertainty with which big money, which requires large, deep markets or assets to park in, is facing today. And in that context, the complacency in terms of relatively low volatility in bonds as gauged by as reflected in the MOVE index recently, or even the VIX with equities, shows you that these things, really do approach extremes in either direction. But it's the existence of those extremes that reinforce to me that the underlying bull market philosophically is intact for gold, because big money will require a parking spot wherever it can find one, and it's still making up its mind like that loose cannon on the deck of the world in a tempest-tossed era. So enough of my philosophical kind of waxings, but that's kind of how I think about the sort of underlying substrate of what drives gold onward from
Mm.
here.
I'm glad you mentioned Hubert Herbert, because actually it's kind of been playing in some of the information I've been consuming the last couple of weeks as well. Not that I've done a deep dive into, Hoover's presidency and his memoirs. I haven't read those as you had eloquently talked about. But I do know I was watching a documentary about the crash of 1929 and prior to, obviously, boom time. And actually, President Hoover, when he came into office, was talking about prosperity for everyone. The United States market, the economy is this beacon of light throughout the world. Everybody's getting rich. Everybody's piling money into the stock market. I mean, between President Hoover and what we're seeing in the last number of presidents, and leaning on the stock market to be a campaign rally for themselves. And what we're seeing now, we just saw President Trump at the UN Assembly saying the United States is the hottest country in the world. So there's resemblance there between the presidencies. Now we're just seeing what we haven't seen is any sort of fallout in this market as we saw in the 1929 crash. Now, I'm not calling for a crash, but as far as like leading up to 1929 and the amount of capital into the market, the number of investors, the number of people pushing cash into the market in speculative natures, and what we're seeing out of the executive administration, it obviously rhymes. Like there are many similarities here. Um, when
Yeah,
did?
it's
Oh, go ahead.
sorry. I couldn't agree more. And it's that classic history doesn't repeat, but it rhymes.
Yeah.
And where were the signs? It's amazing that human scientific knowledge is cumulative, but financial knowledge is cyclical, right? Like each generation has to relearn the same mistakes because of the underlying fear and greed. To your point about signs of speculation, it's interesting because I think I know the documentary you mentioned about 1920s into the Great Depression. And ironically, the economy had been rotting for some time ahead of the 29 crash from the bottom up, which is very similar to what we're seeing in terms of the bottom end of the pyramid of the income of Americans rotting and kind of hanging on by a thread. We're seeing, and there are things that people are well aware of here. I think the K-shaped economy is a well-known sort of narrative in markets. But people forget that student loan forgiveness is back on, and wage garnishments started in September. So if you think the sort of default data is bad now in subprime auto, or credit cards and defaults and charge offs, like it's not it's not getting better in the near term. There are things happening here where the system is kind of the economy is rotting from the bottom up, and this is also very kind of EMification of the US, which I think we've talked about before, that I've been vocal about for a few years now since COVID, where the Gini coefficient, the sort of skew between the wealthy and ultra wealthy and the top versus the bottom um, rises. And that was also something that we saw in the 1920s. So, underlying this kind of mania for equities and mass participation by retail in the markets is actually a divergence between the cartoon that is the market that's supposed to be representative of economic activity, and it diverges for several years and sets up for something pretty nasty. The signs are also there in things as anecdotal as Irving Fisher, who wrote the book or the treatise on the debt deflation of Great Depressions, which everybody read in '08 after Lehman. People know that he was also the author of the famous statement in October of '29 after the initial crash, or after the initial correction in the market, literally 1 month after the top, where he gave a speech at a club here in New York, and he mentioned that he believed equities had achieved a permanent plateau. I mean, I almost fell out of my chair yesterday when I read that the head of U.S. strategy and quantitative strategy for Bank of America Merrill Lynch, Savita Subramanian, and I can quote you. She literally wrote, "The S&P trades rich on 19 out of 20 metrics, and four just hit all-time highs. Market cap to GDP, price to book, price to operating cash flow, and enterprise value to sales are all at fresh highs. Buying stocks at these multiples feels bad, but there are good ways, sales, EPS, GDP booms, and bad ways, price declines, to resolve this seemingly untenable situation," right? There's that divergence between the cartoon and reality. Or perhaps this situation is not untenable. I can't believe she wrote this. "The index has changed significantly from the '80s, '90s, and 2000s. Perhaps we should anchor to today's multiples as the new normal rather than expecting mean reversion to a bygone era." I'm sorry. As I say, I almost fell out of my chair because we are very long in the tooth in term, and then more anecdotes. I regularly run into people who are trading who should have no business doing so. Like, we're right back there in 1999, 2000, where college roommates of mine were opening Daytech online accounts, which is the predecessor to Ameritrade, to trade out of their dorm rooms, literally right around the top. I know a history teacher, a buddy of mine was telling me, his close friend is quitting his education job and just gave notice that he's gone at the end of this semester in December because he wants to trade full time. I mean, it's scary in the sense that, like, and then FINRA came out yesterday with a new rule where they're removing the $25,000 minimum account limit to be able to day trade. So we're scraping the literal bottom of the barrel in terms of small lot size for guy and I can give you so many others. I regularly take Ubers where the driver has Robinhood app open on his phone while he's
Yeah.
driving, and he stopped at the light. Oh yeah, yeah.
Yeah.
No,
Yeah.
and it wasn't like this even a few months ago. We had a bit of this with crypto back in 20 and 21, going into the kind of GameStop meme mania, like around the ARC, Kathy Wood high in early 21. But we were right back there. And what's crazy is that we're doing this, less than 5 years later, after a pretty nasty bear market in 22 and 23, in both equities and debt. And the financial, the brevity of financial memory just keeps getting shorter, which tells me, like, in that era of debasement, this is something that my buddy LeShrub, we do a little occasional, we talk every day. We'll be on the phone every day, every other day. And every once in a while, we just turn on record to, let people kind of listen in on what two guys, operating in the markets are talking about. And he likes to say there's really no top in a world of debasement and the golden age of grift, where the government will just step in a hurry at any sign of trouble to backstop asset values.
Right.
And I'm sympathetic to that, but that does not mean so that kind of takes, Great Depression down 90 off the table. I'm not calling for the end of the world here, but when the market rinses this kind of behavior out, we are always amazed in retrospect at how fast and how hard that happened. So I am, not to put too fine a point on it, quite concerned for risk, like acutely so, right here, right now in the near term.
Mhm.
The signs are there that we are now days, weeks, rather than weeks, months, or quarters from another downdraft in risk. And so that kind of gets back to how does gold behave on the backside of that mountain while we rinse, a lot of this behavior out of the market. Ironically to me, I like to go with views that are most invisible. There is an absence of true bears out there on social media and other venues calling for a serious downdraft and risk. And I don't mean to use the word crash, but something nasty, akin to April or what have you.
Mhm.
What I hear is either, melt up into year end because we're kind of closing out the seasonality window after Yom Kippur, or we get a 3 to 5% correction and it's healthy. Okay. Who out there is looking for 10 or 20, maybe 25? Nobody. So that's not to say that downside protection is cheap either, but when everybody thinks something is going to happen, usually something else happens. So, um, sorry to kind of drone on with the answer, but that kind of brings full circle how I'm thinking about
Yeah. Well,
the top down from here.
you've given me a lot of things to think about in the back of my head and try to follow up question, but I think what I'm at the forefront, going not to delve on this, but I want to go back to that Herbert Hoover idea. And you mentioned the loose cannon on deck, the loose cannon on the deck of the world, and kind of where we're at here. And though, if these traditional safe assets, such as U.S. Treasuries and the dollar, no longer unequivocally safe, where does the cannon point next? I mean, where do people go and hide if they have remaining liquidity that needs to be hidden and put to work somewhere if it's not risk assets?
I think we know the answer there. Gold, Bitcoin as an opt-out, although I don't really own any here. I view it as kind of the very sensitive, farthest point of the liquidity needle that kind of swings the hardest when there's some kind of problem in the plumbing or in liquidity in general. Um, and it's, people forget in that ecosystem how quickly it starts to trade like the NASDAQ when things go risk off. But real assets or things that are, kind of opt outs, equities therein. I find it fascinating that, gold miners have left so many investors behind as an investable option, even in the value space, despite record free cash flow yields. I was talking with a buddy who was at Beaver Creek and Denver Gold last week,
Mhm.
and he mentioned to me he caught up with a mining junior that he, junior producer that he a year ago he met at the same function. Company was, I don't know, 800 million in market cap at the time. Now they're bringing on production next year, and based on where gold was a year ago, the thing was looking at a 2026 of 3 to 4 times cash flow. Today, sure, costs have gone up a little bit, but given the move in gold, the market cap of the stock has doubled on price appreciation, and yet it's trading 3 times cash flow. So you've had a huge re-rack higher simply because the all-in sustaining cost and cash cost for this business hasn't really moved much, but the gold price has exploded, and the market, I guess it's a classic mispricing in the sense that the street doesn't think necessarily that these prices can be sustained. It takes time for the sell side and the buy side to get comfortable with $3,000 gold. A lot of the sell side is still working with a two handle in terms of a long term price.
All right.
And hey, maybe they might be right, but if they're right, then risk is grotesquely mispriced because the amount of liquidity withdrawal and deleveraging that will be required to make that price the correct one in gold is politically untenable for America at the current juncture. If you know what I mean, like people will not take the level of pain required to make a $2,500 gold price make sense.
Mhm.
So somebody's going to be wrong there, and I don't think gold is ultimately going to be wrong. My concerns are purely short term
Yeah.
from positioning.
Hey, you're a well-connected guy, living in the hub of the international world. What is your sense? Are you, I would guess you're seeing more people within the institutions there in New York pick up on the gold trade and having some sort of allocation, but give me a sense. Like it doesn't feel like a fervor. Like I think at Beaver Creek and Denver Gold here this month here, Paulo, my sense was, I mean, it was frothy and it was like an internal froth. We were all super excited, right? Like companies are making money, valuations are two, three, four times higher than they were a year ago throughout the lifeline of the chain, whether you're producing gold or you're exploring for gold in early stage project. There's always an internal froth, but I'm not getting the sense that, people on the sell side out of the institutions in New York are exactly diving into these things, even looking at the returns we've had in the last 6 months. What are you sensing?
I agree. And ultimately, that leaves me constructive as we look out medium and longer term. The real money hasn't even begun to move, and it's interesting because narrative drives price, and
Hmm.
a trend in price is really just the spread is the visualization on a chart of the spread of an idea. And has this idea really spread? Okay, I could tell you that when I see articles about gold in the Wall Street Journal, like I have recently, um, I get a little uncomfortable, especially in the context of recent retail participation, just purely from a near-term positioning perspective. But it's also a reflection of a growing awareness of an asset class that until not long ago was basically invisible and given up for dead with the price near all-time highs. And I'm rewinding, a year.
Yeah.
Um, it's kind of almost like what happened with Bitcoin over the last few years. I don't mean to mention Bitcoin again, but the psyche is similar in the sense that you have the haves and the have-nots, like the people who are in the room, like in Denver and Beaver Creek, who are feeling really good about things. Um, and they're looking around and wondering, when are you big guys going to wake up and, like what's it going to take to get you in the game? You know what I mean? The difference with the miners is you have real cash flow that fundamental investors should be able to underwrite comfortably, even with a correction in the gold price. It's interesting because we saw something similar also happen in oil, where once oil came off the boil in 2022 to 23 post the invasion, a lot of the equities continued to work for a long time thereafter. And it almost seems to me like the real tell that we're in a secular bull market, as clear as day, is first when the equities start outperforming the commodity, which was not the case until this year in gold, and B, where the equities hang in despite a correction in the commodity price, which was the case for oil equities. I mean, they haven't performed well by
Yeah.
any stretch, certainly on a relative basis, but you haven't lost a catastrophic amount of money the way you would expect with an oil flat price coming, off of 120 to 60. You know,
Hmm.
there's been a huge multiple compression there as well. And I recently posted a meme on Twitter where I said, is the guy sitting outside the college campus drinking a coffee. And he says, I wrote, oil is to 26 what gold was to 25. Change my mind, because we're seeing a similar kind of compression and sort of tension building in a space that has fallen to such a small percentage of the US equity market cap that you can fill the entire oil space in one or two Mag 7s. Again, it's elephants through a keyhole when that bowl of water starts to, slosh around and global capital starts to move to things that they can underwrite with real margin of safety, whether it's dividend and cash flow, whether it's purely just conservation and preservation of wealth. So the one misfortune I have right now is that suddenly in the last month or two, everything in the commodity complex and related equities seems to have started to work simultaneously. And I hate that because I've been successfully working for the last few years with this framework that I wrote about in a very early note when I moved to Substack in January of 24, where I talked about this commodity super cycle feels different because it is, unlike the 2000s when we're, an emerging China lifted all boats, backwardated all curves, and allowed through non-correlation with fixed income and equities to become its own asset class that was investable by big money to the tune of $300 billion of pension fund and other allocations to a passive roll down futures long commodity strategy that was uncorrelated and collected carry from selling the near term future when it comes close to expiry and rolling to the next one down and riding the roll up. then you really rang the dinner bell for the entire commodity complex to inflate. This time around, it's more supply constraint driven over the last 10 years, where these commodities kind of hit the brick wall of supply constraint at different points in time. So you see nat gas in Europe go ballistic with thermal coal in late 21. You see nickel explode on the LME because some guy got caught short in 22, along with the oil price on the invasion. Then Henry Hub went nuts that summer. Uranium became the story of 23. Like, it's these rolling crack ups that are supply constraint and underinvestment driven rather than the demand statement of an India or a China. But now it seems like with the dollar weakening and all of this kind of debasement, institutional confidence crisis that we talked about, that is a huge tailwind for the EM or non-US demand side of the equation to kind of dust itself off and pick itself up off the mat. And that and so I think that's what we're actually starting to see with all commodities starting to move together here. It's a different way for me to kind of let my sitting do the work. And I think that's what has really changed in the last few months is you're starting to see at the margin the money move a little bit. We are seeing inflows, for example, in the commodity complex across the board, even if it's not really showing up in GLD and precious metals outright. And a lot of these ETFs are actually still seeing outflows in the miners, for instance,
Yeah.
which is wild. But it doesn't. It just goes to show you how narrow, how small the keyhole is for the elephants when just a little bit of money at the margin tries to move. The entire space inflates all at once, and it's everywhere. It's tanker stocks because suddenly VLCC rates are at 100,000, and no, and this is another thing that I find crazy. No one is paying attention outside of Beaver Creek or the ecosystem of people who have been taking pain. The Canadian oil mafia, what have you, all these little, mining Twitter, little ecosystems of people who know this stuff well. The
Mm-hmm.
generalists, no one is paying attention. I was ranting like crazy just to give you a little bit of a tangent and sorry to drone on, but I kind of like this story. I called up Le Shrub yesterday morning around
Mm-hmm.
the open because I'd been kind of ringing the bell in chats with my friends recently about Grassberg and
Yeah.
Freeport admitting that there was an issue with an underground mudslide a couple of weeks ago. And a few days ago, I even put in the chat with LaShrub and others, guys, are you looking at this? Like, are you aware of what's going on there? I was just starting to hear local press and local stories come out about this, and I'm like, there's a real issue here. And then Freeport drops that PR yesterday before the open, and the copper price was up 1%.
Yeah.
And I'm literally sitting there having just watched The Big Short last week, and I remember that scene where Ryan Gosling, who plays, I forget his character's name in the movie because they changed the names of some of them,
Yeah.
but it was based on Greg Lippman from Deutsche, who was kind of considered the bubble boy or the Chicken Little of the mortgage backed space and the housing bubble, and he's pitching the Front Point guys, and these guys are shocked at what they're hearing, and they're like, how is this even possible? And he says, no one is paying attention. Like, it's amazing how little people know anymore, and they're so demure because nothing
Mm-hmm.
ever happens, whether it's geopolitical risk that constantly fades, whether it's volatility bursts that constantly get snuffed out. It's people have just completely either mentally checked out or have stopped doing the work or are still doing the work but just don't care because they don't want to stub their toe seeming like Chicken Little. But do the math. Freeport is one of the it's the largest copper producer in the world, almost 2 million tons last year.
Yeah.
Okay. The copper production globally on the primary side, leaving out recycling and scrap, is like 23 million tons ish, might be off by a million. So, this Grasberg mine, in addition to being the world's largest gold mine, which people forget, produced 820,000 tons of copper last year. Okay. This thing is the second largest copper mine after Escondida in
Right.
Chile. And they just told you that not only is it, I mean, not all of it's off, but they have a serious issue where maybe it's running at 30% of nameplate, not only this year, but next year. And that
Yeah.
potentially comes back on in a ramp in 27. And you do the math,
2027.
like what's 70% of 810,000 tons? Oh, so you're telling me that what, 600,000 tons almost is offline
Right.
in a you just knock 2% out of global supply when the street is working with a small surplus of 200,000 tons ish for next year. And you just made that 400,000 tons of deficit with, granted, exchange inventories are somewhat high, but over 60% of global exchange inventories today are sitting on the COMEX because of Trump and everybody shipping tons over here to get ahead of tariffs earlier this year. So LME tons are not, we're not at exchange bottoms and empty pallets, but they're not high. And the copper price was up 1% at the open.
I know. Could
Just
you
no one
imagine? Could you
is
imagine
paying
if we were?
attention.
Oh, I'm sorry to interrupt you.
No, no,
Yes.
no. It's just no one is paying attention.
So what's fascinating about this story? I mean, and my heart goes out. Like, working in this industry, we know mining can be a dangerous business, and so losing 7 people is terrible. But if you look at the backdrop of the story of Grasberg, you're talking maybe they can get back up to pre-disaster production in 2027. This is not the first copper mine to have, shit hit the fan and come offline this year. You know, Ivanhoe's Kamoa mine had an emergency earlier this year that brought that production offline as well, and they have to work through this over the next. I have to go back and look at the timeline, but I think the next 18 months is as they try to dewater. Now they have a little bit. They have some other uh, mineralization that they can process from Kukula that obviously kind of provides a little bit of padding, but that's more copper offline. And if you just think about it, like the big picture here is that the supply with demand, that curve was so tight going into this year. And now you bring two major producers, you cut those productions back. Turning that back on is close to impossible, just given the timeline of bringing mines online and getting production started from new projects. We'll be lucky if we see something new in the next 2 years. To be quite honest with you,
There's
but
nothing really of consequence that comes on, and the examples are numerous. Like Hudbay right now, isn't Constancia in Peru offline because of protests? Like that's 100,000 tons per annum,
yeah,
right? It'll come back, but it's like there is there is not a lot of margin for error, and this is a big one. Again, putting aside the loss of life, but that also plays into this because I went through this in a former life with a focus on Latin America when Mariana had that disaster in Brazil, followed by Brumadinho. Two iron ore operations where the wall, the side of the mountain literally caved. You could even
hmm
see the videos. The entire mountain literally caved, and this stuff just went all the way to the ocean. Killed. Mariana was less loss of life, but more than admittedly what's happening here at Grasberg. But it was a shock for the market. And this is, we're not talking about, 2% of, well, 3.5-ish% of global copper is Grasberg. And maybe you're knocking 2% of that off with this for indefinitely. But, Mariana and Brumadinho were not 2% of global iron ore production. You know what I mean? And
right.
it still rocked the market, something pretty hard. And Vale is still trying to settle on fines about what happened. This is going to be an S show. I don't know if I can swear on this, and we don't even know yet if there was um, lack of foresight or outright malfeasance here. I don't want to speculate, but block caving is difficult business underground. There are some people who have been posting a lot about this on Twitter that you can read about. I'm not a mining engineer, but I've been in a few of these and I kind of understand the difference of, what is drift and fill versus, stoping versus block caving. Block
Mhm.
caving is difficult, especially in an environment that gets a lot of rain because you have a lot of water content underground. And it sounds to me, again, pure speculation on my part without being an engineer, that maybe like a hanging wall collapsed or something and exposed an underground water flow. So basically, they hit an underground river, and the mudslide just whipped right through. And Grassberg, people need to understand this thing is enormous. It's
Hmm.
like imagine like the hive from Resident Evil underground that runs for miles in every direction in terms of tunnels. Like there's a whole ecosystem of thousands of people working under there all over the place. So, but there's water everywhere, all over this deposit. And you do gravity testing in block caves to find these water bodies and drain them. What if Freeport got cheap, right?
Right.
And cut a corner? In the same way that nobody's drilling out their ore bodies for reserve growth because, they have been wanting to focus on buybacks and capital returns. So, reserve lives are coming in. You know, there's a potential issue here where at a minimum, and this is happening in a country that politically is seeing unrest, right? They're having certain
Right.
turmoil at the top. I'm not in the weeds on what's going on there. I am not an expert on Indonesian politics, but the little I've read suggests to me that this is the sort of catalyst that creates a real issue with the populace. And I wouldn't, in extremis, take, you know, investigations, a Cobre Panama type
Yeah.
situation where the
Exactly.
government
Exactly.
just says, what the hell happened here? Everything stops for the next 2 to 3 years, right? And ends with fines up the wazoo, no production, and potentially even nationalization, because that's what happens in emerging markets. Like this is a fiasco of very large proportions that wouldn't matter if it was 100,000 tons a year, but this is a big one. You know what I mean? Like
Hmm.
and no one is paying attention. It's just, I keep coming back to it's a that if you think markets are efficient today than they were 10 or 20 years ago, because whether it's active managers all got blown out by passive over time with the loss of AUM, fewer people caring about this space than they did 20 years ago during the last bubble. So you lost eyes on the sectors. It's amazing to me, but I'm seeing opportunities, and I don't mean to couch a disaster as an opportunity. I'm seeing market setups in the context of opportunities to drive another classic case of a space that's been shaking itself off from the bear market of 24 and early 25. And we've run a lot. The equities, if anything, even concern me a little bit because a lot of the miners have outperformed. The equities always move first in a
Yeah.
bull market that's kind of secular, right? Like that's what's the miners outperform now.
Yeah.
But the miners and especially the juniors, like they're all missing targets. Brownfields are not coming on as planned. They contracted at the wrong price 2 years ago, because they wanted to bring stuff on, and they're discounting maybe $100 a pound with the spot price still kind of in the low 80s. And it's a move. Like we've moved off of a 60 high 60s low several months ago to kind of 75 before the recent sort of froth started to come, capital started to come into the space again on the sequesters. Like the people who are inside this space are very vocal that like, wow, like we're back, right?
Mhm. Yeah.
Almost gives you a little bit of concern as we flush to new highs on, URNM, the ETF, or next gen. Like it always concerns me because everything is a flush. Like you have to backfill flush 80% of the time in this market. So the trader in me tells me like, oh, okay, like maybe we're in for some factor guys will also drill it when AI sells off. So you want to be careful where you are in this space. And it's hard to find value because as I say, a lot of the equities have already run well ahead of the spot price. How do you buy some of these miners that are already discounting $100 plus a pound? It's almost like the spot price now needs to kind of catch up a little bit. So maybe there's a little bit of length in the market overall to ring out from the miners to the sequesters or the kind of pure plays. But overall, outside of the people who watch the space closely, the handful of people on Twitter who, are uranium bulls like, Tommy to the mast guys, nobody is paying attention.
Yeah.
You know what I mean? Like people, it's almost like a curiosity for some guys, like, oh, like what's going on over there? Maybe I'll buy
Yeah.
some Cameco, in the same way that people would just buy Freeport if they wanted a little copper because it's the only liquid name. It's the only name in the S&P 500 that's copper. Well, that didn't work out for them yesterday, but it just shows you that the space is still very small and it doesn't take a lot of money in the context of things. Sprott has raised what 200 million bucks in the last since Labor Day, bought 2.5 million pounds. And when you run the numbers on that kind of money, it's nothing. It's a
Right.
rounding error. You know what I
Right.
mean? So again, short term, maybe maybe pretty girls also get hurt in a bus crash, but I just think this stuff keeps going. And what's interesting also, like in gold, um, a lot of people have been burned in uranium, not just last decade, but more recently with 24, 25, where we came off of 107 in early 24 to the upper 60s. That's quite a correction to sit through. I get it. It's hard to stay in something like that or revisit it. Um, Others are getting nervous as we speak, which is a proverbial wall of worry as you make new highs, because as the market shows us, that it's precisely that kind of nervousness or even skepticism that causes the market to keep going. Like the stuff that's meme, reactor adjacent, like the Oklos of the world, which is crazy. I mean, this thing is half the market of, size of Cameco today. Or yesterday it was like over $20 billion in market cap. I don't know what to do with that. Like that, that's not for me. A
Yeah.
company
Yeah.
that has little line of sight to making money in the next few years is just another liquidity spear. And if it's selling off, it's telling you that, me outrageous call buying and levered trades. I mean, they have a 2x levered single stock ETF on Oklo, right? Like, what does that tell you? Um, but and unfortunately, some of the other equities have also run ahead of the spot price, as I mentioned. But it doesn't mean that there's nothing to do. It does tell you. Personally, I'm surprised I haven't seen more issuance in the space over the last few weeks. I know it's coming, but I would have thought watching UEC and Amir, the worst thing that guy could probably do for his share price is actually mine uranium because mining is hard, right?
Yeah.
But while people are still looking out, 7 billion in market cap, 7 billion, Trevor, is crazy,
Mm.
right? I thought for sure he's gonna, and the stock actually I thought was gonna do a buy the news, sell the fact on the res, not just go out there and raise 500 million bucks now, right? At a $7 billion valuation. Like Goldman Sachs just initiated coverage on the stock with a buy a month ago. You don't initiate if you're Goldman on a stock like UEC
Right.
unless there's something going on. Like there's some business case here. Like I did syndicate and I've been around deals long enough to know the hallmarks that, you know, that, might need to be fed. But he didn't. And that's not to say he still won't, but it just goes to show you the lack of investable options at
Right.
$80 a pound, right?
Right.
So that just tells me the price needs to go up, not necessarily to justify the extreme valuations in these names, but it just goes to show you, like, if the Aussie names like Boss and the Paladin and these others, keep missing, keep having to raise, that Paladin raise I heard, the 300 million they raised last week, that was 10 times oversubscribed, man.
Wow.
Like, yeah, there
Wow.
there was demand for it, and this is not exactly a name that's on the highs,
No, no.
but it just goes to show you, like, without concerted and in uranium time, 10 years, 5 years is like tomorrow, right? Because of the lead time in not just developing assets, but just placing orders for a final fuel fabrication. Like the lead time is a lot
Yeah.
from buying U3O8 to taking core delivery. And so there, like with, what you described with copper, there's no room in uranium. It's stark. Like there is no room for error. We need every brownfield to meet target. We need every greenfield to come on, when including Rook, Arrow Rook One from next gen, on time by 2030 or 31, which I don't think it will. Literally every greenfield and brownfield, like MacArthur needs to get back to 18, and they need to take that to 25. They need to bring Rabbit Lake back. Like we
Yeah.
need all of this stuff, and we are still coming up short in 2040. So, like, there's no room for error. I mean, I think Cameco might be slow walking a bigger issue at MacArthur River because first they said mining is hard at the quarterly in late July. And then a month later, they dropped that presser where they had to cut from 18 million pounds to 14 million pounds. I think we're going to look at 2026 and realize there's a bigger issue. This isn't back in 23 when they warned about the uranium mill and labor and they needed some parts and they solved it in a few months. There seems to be like a clay geological issue going on here, potentially. Who knows? But just imagine skating forward 6 months and 18 million pounds for 26 is off the table. Like
Mm.
there is no room for error. I mean, God forbid there's a
This
flood.
It's just
like what
like the
happened.
copper. It's just like the copper
It's
market, man.
just like the copper. There is no room for error.
No.
And that to me suggests asymmetry. So a lot of guys who are either not in the trade now or in the investment, as it were, or are stepping out of fear of, again, I accept everything's a flush. It's a little frothy near term here. A lot of guys have been buying calls. A lot of people, some people even posting their P&Ls. I get it. But the wall of worry from people who should be in this trade is there. The skepticism around embedded valuations in some of the miners is there. And the new money has barely begun to wake up on this space again. And the nukes, the utilities who are the end commercial buyer, are totally asleep at the switch here. My understanding, the latest feedback I'm getting from the industry just in the last few days, because we've been waiting for RFPs to come out, is that with this latest move in the spot price above the $80 term, now they've decided to step back and wait again because they just assume that the price is going to come back in and then they can recommence discussions. It's like, how long are you going to continue to do this when you're running well below replacement this year, right? And the last couple of years on that, and the inventory just keeps coming in and getting shorter, and you're competing with financial buyers through sequesters who are going to squeeze you,
Yeah.
right? Like,
Yeah.
I just, when it goes, it's going to go. You know,
Yeah.
I don't know if it's right now. Quarter ends around the corner. There's a lot of sloppiness on the tape. Again, AI adjacent stuff could get killed. Some of these, bigger names could get caught in that as well. But man, like, just take a longer term view. The
Yeah.
direction is
Yeah.
higher.
I suppose I need to consider you for an interview on our Going Nuclear podcast we do with Justin Hune here on the on the network too. Maybe that's something in store here in the coming months to see how that plays out. Paulo, I know we're kind of going a little bit long, but I have one more question
Sure.
for you, and hopefully I can get it. I'm having some terrible connectivity issues. I think it's stabilized now. Um, but I got to ask you, and we can try to keep it a little bit short just so we can get people out of here. But I got to ask you on the back of this, the U.S. government taking equity positions in resource companies. We saw it back with the MP Materials deal earlier this year. This week we got news that the U.S. is taking, I think it was 10% equity stake in Lithium Americas. We knew that deals like MP Materials were going to duplicate. It was going to happen again somewhere somehow. Same terms. The Lithium Americas one is a head scratcher because we have an administration that has been so have anti renewable energy, infrastructure. They've been all about the fossil fuels and keeping energy prices low. What does the U.S. government need Thacker Pass for? Why is it so crucial for them if it doesn't fit their priorities of what they've communicated under this administration? And what are the dangers of the U.S. government taking equity positions in companies such as we've seen?
Right. So I talk a lot recently about having to hold two opposing thoughts in your mind at the same time, kind of like Alice in Wonderland, like think
Right.
six impossible things before breakfast, but you have to hold two diametrically opposed philosophies or views together and make peace with that kind of tension created. One of them is this is very China of us, state directed investment with stakes in private enterprises from semiconductors like Intel to critical minerals. The libertarian in me says, whoa, right?
Yeah.
But then again, uh, I appreciate to no end the sort of strategic vulnerability that America has put itself in through the relentless outsourcing over the last 40 years and especially the last 25 years since China joined the WTO, where we sleepwalked into a situation where China, either in outright mining or more importantly, processing and refining of key minerals from rare earths to tungsten to lithium processing as well, um, accounts for, in some cases 80-90% of global refining and production. And we've entered a world very clearly of increased competition where that that trend cannot continue
Mm.
for the national security of the United States going forward. I'm not saying it all has to be made in America. But I understand and appreciate the vulnerability, particularly where, as we saw, there are some things where there's no margin for error. And if the magnets don't show up, the missiles don't get produced and the bullets don't get made if the antimony isn't here. Like, I understand the move. Um, and frankly, considering that China, if you've ever seen where rare earths gets processed in China, I wouldn't come within 200 miles of that place. It's literally a cesspool out in the open, of all sorts of things that, like, if you were to drink a teaspoon, would kill you. Um, the environmental and labor arbitrage that China has conducted in the processing of a lot of these materials has made it uneconomic for the rest of the world to do the same. Stands to reason. So if you want to do it yourself, you need a much higher price for the private sector to allocate capital to it. People are not in the business of throwing money into the fire unless it's CoreWeave and NVIDIA. But so the government, I actually liked some elements of what they did with Mountain Pass, for instance, in terms of guaranteeing a price that was 2 times above spot for domestic production. Hey, look, there are no atheists in foxholes, and this is an economic war. Um, Maybe it was one that we kicked off, quote unquote, with our choosing under Trump one, but it was bound to happen eventually because the societal fabric in America is tearing from relentless outsourcing and growing inequality, and people were eventually going to vote for this change. So this reshoring makes sense to me. Paying a price well above the global price, which is basically depressed because of China's um, labor and environmental arbitrage, lowering their cost of production. Um, that makes sense to me. The equity stake stuff, where Trump is acting as investment banker because he loves to do deals, rubs me a lot the wrong way. And frankly, like, I was shocked, but not surprised, I'll say, when Lithium Americas doubled on the announcement that they're renegotiating the loan, and part of the deal is 5 to 10% equity stake in the company. It's like, okay, so you're diluting the equity holder by 10%, and we haven't seen terms on the debt, and you're going to double the price, and then it was up again 20% today. But it's more fitting with a thesis and kind of ties back into the golden age of grift that my friend Lishrub likes to talk about, where when you are in debasement, and take that in extremis, 1920s or Weimar Germany, like, just to really kind of shock people. That's not what this is. But the closer you were to the source of the fountain of money, the better you were. So inflation always benefits first the people who are most politically well connected and the corporations or individuals therein. And so I think the market, for all that the math doesn't make sense, like, you don't want to short these candidates because they will ultimately be closest to the money spigot that is being sprayed all over this field. Um, and again, this is a problem that I don't mean to get into politics, because I'm kind of like Mercutio, like a plague on both your houses. I just, as a Brazilian, I hate politicians of all stripes as like a baseline starting point. But what always troubles me about Trump, and again, I'm very sympathetic to a lot of the policy, as I mentioned, but it's always, there's a kernel of truth wrapped in a cartoon.
Mm-hmm.
The cartoon is these guys running around just spraying money at everything, and it, it's it's you have to put all of that aside, your political leanings or what have you, to be successful in the years to come. The money is going to keep going, and it's not. This also brings us into AI. AI is not going to be an easy, NVIDIA is not going to be an easy short. There's no easy short, but this is not going to be a bubble that ends the way we've seen others end, because the government is on side. The government is telling you, we are at war with China over data center capacity and AI, and we must win this. And we are going to throw trillions of money at this, to the point where I hear behind the curtain, they are now discussing with asset managers, the PIMCOs of the world, these big guys, BlackRocks, who are, again, close to the money spigot, the politically well connected, to look at the new securitizations that are coming out in the data center space, where Oracle takes the equity, Blue Owl takes the subordinated debt, and the investment grade fund at PIMCO takes the AA, AAA piece. Like they're CDOing, they're ABSing this stuff now. Now you could say that's crazy. We're piling leverage on something that has a 3-year useful life. But what if it's 2004? Because the financial resources and the leverage is just getting pushed in that direction. So
Mm.
your dad might own the BlackRock investment grade, $100 billion investment grade fund and not even realize that a sliver of it moving to 5 or 10% is going into AA and AAA securitizations in a data center ABS. My buddy
Mm.
Shrub joked about this a few days ago, and we started looking into this, and we were shocked to find that this is actually happening. He joked with, "We're going to be doing AI BS, uh, uh, artificial intelligence backed securities, or AI bullshit."
Yeah.
And I love the guy because Shrub is irreverent, but he's got the one of the best noses of anybody I know in the space. And we started looking into it, and we're like, no, this is happening by the billion already, and financial resources are just getting mustered to it. So, do I am I waiting for the backside of the mountain? I think we gut check, right? Because the signs are
Mm.
there. But just keep in the back of your mind, this could still be 2004 because they are just starting to marshal the big money resources towards this because the government says so. And that's the world we live in now. It reminds me of when David Tepper came out from Appaloosa in 2010, and we were correcting, we'd had the flash crash, and he came out in September after Jackson Hole when Bernanke did his big QE speech, and he said, I think he used the expression balls to the wall, long stocks. And everybody was shocked, including myself. I'm like, you don't think that this is squishy? Like we're 18 months out of the hole, and market functionality is failing, and economy looks like it's squishy. And he goes, it's very simple. The Fed is on your side. They've
Mm.
said, if things get better, stocks go up. If things get worse, they're going to print money and stocks go up. It's literally win-win. And I hated hearing that. I didn't respect what I was hearing because, and like so many others, which was the wall of worry and concern that we had to mindlessly climb for the next decade plus. I mean, good on the guy for nailing it. That equivalent today has turned into this meme of not just you don't fight the Fed, but you don't fight the fiscal and you don't fight Trump. Just stay as close as you can to the money and try to figure out where he's going to spray it next. So for me, I joked on my
Yeah.
Substack chat yesterday. LAC just doubled on this thing. Next, so lithium, we know what the list is of what the minerals they're going after. I sadly sold out of some small cap, kind of a couple of $100 million names up 50% that are now up 200 just in the last month. But it occurred to me like, tungsten is next, right? Like we've seen the antimony deal, we saw lithium. Like, what if tungsten or one of these other like little corner cases is next? Like, how do we play that?
Yeah.
I have another phenomenon. Sorry to go on, and we can kind of leave it there. There's a phenomenon called that I call who's next or snap count. In a bear market, when somebody fails, investors naturally ask who's next. So 2008 classic example, Bear Stearns goes to the wall. It took 6 months, but people were quietly asking who's next. And the answer that kept coming back was Lehman, because Bear was 50 to 1 levered on equity. Lehman was like 35. And then
Hmm.
once Lehman went to the wall, the who's next was instantaneous. It was literally next day. It's the order is Merrill Lynch, which ended up going to Bank of America the next day, uh, Morgan Stanley, and Goldman. And in the background, what the hell is AIG Financial Products and what did Joe Casano do over there? Right? All in a week. So you have this like fuse, something happens, and then all the dominoes suddenly topple at once because people wake up to what I call snap count or who's next.
Right.
2 years later, European crisis. Greece goes to the wall. Guys sit up and say there's a bigger issue here. Pigs became a thing, right? Who's next? Ireland and Portugal. Who's next? Spain. Who's next? Italy. But you had to keep going because who's next after Italy? France. And that's when Draghi came out and said the whole like, we're going to do whatever it
Whatever it
takes. And
takes.
believe me, it'll be enough. Right.
Yeah.
But that also works in the bull market, as you can see, which plays back to my kind of rolling crack ups in commodities. The guys who are getting this joke are asking who's next.
Right.
And I think that's got to be part of the equation, at least in making sense of what you see in the market now. because it's relevant to both the bear market blow up and also the bull market kind of blow offs. And these spaces don't move forever, and then they kind of suddenly erupt and wake up out of nowhere. And it's because money's moving around. Again, going back to the flow chart of capital. Anyway,
Yeah. All
sorry
right.
to wax along, but that kind of brings home a lot of my
No.
thinking.
I mean, listen, there's a reason I asked you on, because again, wanted to pick your brain on a number of these topics that just kind of been all up in our face here the last 8, 10 months here, Paulo. And so, um, we'll see how the rest of the year kind of plays out here. But I think you painted a pretty good picture of where you think everything is heading, and obviously, headwinds that we are now faced with, but also some tailwinds to go about that. And listen, tell everybody about the Substack before we let you go. Tell everybody about the Substack, where they can find you.
Oh, super nice of you to bring it up. I write, I have a Twitter account under Paulo Macro. That's Paulo with a U, Paulo. It's the Brazilian spelling, Portuguese. The Italian is OLO. So Paulo at Paulo Macro on Twitter. And then the Substack is the same, paulomacro.substack.com. I don't write on a fixed cadence, so I apologize in advance for people who are looking for, the kind of regular thing. It's not a daily or a weekly. Sometimes weeks will go by and you don't hear from me because there's nothing to do, and other weeks, like the last few, there's a lot to talk about.
Mm-hmm.
And just tries to be educational more and kind of, sort of looking over my shoulder and creeping into my mind on what I'm chewing on. Probably get stuff more wrong than right, but people seem to enjoy kind of the thinking out loud element of it. And should have also stressed at the top that I mentioned specific securities or commodities for illustrative purposes. Obviously, none of this is meant as financial advice. Everybody should, take what I said and use it more to kind of fill in their own thinking and as kind of one perspective rather than, oh, he's bullish XYZ. Let me go buy some. Please do your own work. These markets are not for the faint of heart, and they punish fear and greed relatively quickly, and they certainly punish people who don't have a firm kind of grasp of what they're doing. So,
That's right. Right.
but yeah, palomacro.substack.com.
Thanks, buddy. Good to talk to you. It's been too long.
Yeah, thanks for the time, and
Yeah.
we'll talk again soon.